Offering housing for your team can be a total game changer. But let's be real, it could also be a massive tax headache. So what if you could flip that script? What if you could turn that headache into one of your smartest financial moves? Well, in this explainer, we're going to open up the playbook and show you exactly how to do that. Look, you've already made the big move. You invested in a property to house your employees. That is an incredible benefit. But now the IRS is in the picture, and that great idea suddenly feels, well, complicated and super costly. It's a classic pain point for business owners, but trust me, it really doesn't have to be this way. Okay, let's dive into the playbook. The IRS has this very specific, kind of rigid set of rules, right? But buried inside that rulebook are two incredibly powerful strategies that can completely change the game for you. We're going to break them down play by play and turn those housing costs from a painful expense into a major tax deduction for your business. So what's the actual challenge here? Honestly, it all boils down to how the IRS sees your money. They basically put your income into two totally different buckets, and their number one rule is you can't mix what's in those buckets. So on one side, you've got your active business income. That's the money your company actually makes from, doing business. On the other side, you have passive rental income, which is how the IRS automatically sees your employee housing. And here's the problem. You can't use the losses from that passive rental property, like maintenance or mortgage interest, to lower the taxable profits from your active business. The expenses are just stuck over there in their own lane. But what if there was a way to legally jump that barrier? And that, my friends, brings us to our first play. This one is all about structure, and more specifically, it's about how you own the property. It uses this really clever exception in the tax code that basically lets you rewrite the rules of the game. It's called the self-rental exception. Now, the magic word on this slide is re-characterizes. That's the key. It's like a little magic trick. This rule lets you go to the IRS and say, hey, this rental property, it isn't passive at all. It's actually an active part of my business. And as soon as you do that, boom, you can deduct all of your property expenses directly against your company's main income. So how do you pull this play off? There are 6 critical steps, and you have to nail every single one. First, separate ownership. Your business itself can't be on the title. This creates the official landlord-tenant relationship the IRS wants to see. Second, a physical business presence. Your company has to actually use part of the property, maybe a room for meetings or storage. This proves it's not just a rental. Third and fourth go together. You have to pay rent under a formal, written lease. This makes the whole thing legit. Fifth, the property owner, not the business, handles major repairs. And finally, and this one is a biggie, you have to get all this set up within the first year of owning the property. Precision here is everything. So you're probably asking, what exactly counts as a major repair? Well, this is where a fun little rule called the de minimis safe harbor limit comes in. Think of it as just a dollar amount set by the IRS. Right now, that number is $2,500. Any single repair that costs more than that is officially considered major. And to keep this whole strategy valid, the property owner has to be the one footing that bill, not your business. Now, if you execute this play correctly, the benefits are huge. I mean, you get to deduct all those property expenses right against your main business income. You get to offset the rental income that your business pays out. And here's a crucial bonus. You create a legal separation that can actually help shield your main company from liability. It's a strategic triple win. All right, let's switch gears and talk about play number 2. If play 1 was all about the relationship between your business and the property, play 2 is all about the relationship between your business and your employee. This is how we make that housing a truly 100% tax-free perk for them. This whole play is built around something called the convenience of the employer test. Passing this test is the entire goal. Why? Because it means your business can deduct 100% of the lodging costs and this is the most important part for your team, the value of that lodging does not count as taxable income for your employee. It becomes a real benefit, not some kind of hidden tax burden. Okay, to pass this test, you've got to meet 3 conditions. First, just like in play number 1, your business needs to have a physical presence on the property. Second, the lodging has to be a requirement of the job. We're talking written right into their employment contract. And third, it has to be for the convenience of your business, not just a nice perk for the employee. There has to be a solid operational reason for them to live on site. Hold on a second. A physical business presence. Does that sound familiar? It absolutely should. This is where you see how beautifully these 2 plays are designed to work together. The very same step you took to set up the self-rental exception is the first step you need to make the lodging a tax-free benefit for your employee. See? They're two parts of one single cohesive strategy. Okay, so we've got the plays down. But every good playbook has a section on rules and penalties. You have to know the fine print because messing up one of these details can completely invalidate the entire strategy. And I really can't stress this enough. You have to be meticulous. These aren't just suggestions from the IRS, they are hard and fast rules. So let's break down the two biggest limitations that you absolutely have to know about. First up, the ownership rule. This awesome tax-free benefit is for your employees, not for you, the owner. If you own 2% or more of the business, the IRS says you cannot get this specific tax-free benefit yourself. It's a really clear line they draw to prevent any self-dealing. And second, you've got to watch the one-year clock. Generally speaking, the IRS sees this as a temporary kind of arrangement. So if you provide lodging to the same employee for more than 1 year straight, its tax-free status could be challenged. The burden of proof would fall on you to show why it's still an absolute necessity for your business. And trust me, that is a very high bar to clear. And all of this brings us to what might be the most important piece of advice in this entire explainer. This is a powerful strategy, yes, but it is not a do-it-yourself project. You absolutely have to consult with an attorney to structure the ownership and draft the lease. And you need to work with an accountant who really understands the specific strategy to prepare the tax returns for both entities correctly. Getting the right professional advice isn't optional, it's non-negotiable. So let's bring it all home. We've gone over two separate plays that, when you put them together, create a complete winning game plan. And here it is, right on the final scorecard. Play number 1, the self-rental strategy, lets you take all your property expenses and deduct them against your main business income. Play number 2, the convenience strategy, makes that lodging a 100% deductible business expense and a completely tax-free benefit for your employee. When you run both of these plays at the same time, they create a complete tax shield around your entire employee housing setup. So there you have it. You've got the playbook, you've seen the strategies, and you know the rules of the game. The only question left is, are you ready to huddle up with your tax and legal team and make the call for your business